Hi, welcome back to another edition of Lippers Fund Flows Insight. My name is Tom Roseen. Thanks for joining me today. I'll be reporting flows for the weekend of Wednesday, September 25th, 2019. For the fourth consecutive week, we see conventional fund business has actually attracted net new money. This week, taking in about $28.9 billion, but the headline numbers are misleading. Let's go ahead now and turn to some of the news that might have made that difference. We had a risk-off mode, and despite the Fed cutting its prime lending rate by 25 basis points on the Wednesday before the week started, and you would think that would be a boon for equity funds, actually concerns of the U.S. trade war with China, the global economic slowdown, and another round of impeachment inquiries pushed investors soundly to the sidelines. For the fund flows week, we see the Dow Jones Industrial Average actually, and this is actually the price-only index, actually declined about 0.65%. That is the best return we saw in the U.S. We saw that the NASDAQ actually had 2 plus some change downside performance. So basically, it was kind of a rough week as people were kind of, again, just tempted to sit on the sidelines, sell off some of the risk, and basically move into that risk-off portfolio, particularly money market funds. We'll see that in just a second. So let's go ahead and see now how the macro groups actually panned out because of this news. We basically see that the mutual fund macro groups, equity funds lost about $8.9 billion. Taxable bond funds saw about $1.4 billion exit their coffers. Muni bond funds, for like the 33rd consecutive week, actually took a net new money of about $1.4 billion. And money market funds saw about $37.8 billion enter their coffers. And again, this is that risk-off mode that I was telling you about. Let's go ahead and take a closer look at the equity mutual fund arena and see what happened this week in that group. We see that equity funds actually lost about 0.86% as far as the return goes. It's the first week in 4 they've actually had negative returns, but it's the 32nd consecutive week we've seen outflows, $8.9 billion this week. And how it broke out is if we take a look, domestic equity funds lost about $7.3 billion. 33rd consecutive week they've seen net outflows, and again it was only a 0.88% decline. But again, investors I don't think were looking at the return, and basically they were just looking at just all the conflicts that are going on right now. It was also the first week in 4 that they've seen a negative performance. If we take a look at the non-domestic side of the group, we see a $1.6 billion outflow, 6th consecutive week that they've seen outflows, and they had very similar returns as well. This time the tune is 0.82% as far as downside performance, and again, it was the first week in 4 that they've had negative returns as well. If I break that down into a further detail, take a look at it, we see large cap funds actually surrendered about $6.3 billion, while small cap funds lost about $664 million, and on the world equity side, we see international equity funds lost about $1 billion. Year to date, we have, and I want you to remember this number, we have seen about $152.3 billion exit the coffers, and that's a pretty significant number, especially when we start comparing it to fixed income and the equity ETF arena as well. In fact, bringing that up, let's go ahead and turn our attention to the equity ETF side of the business and see where flows happen there. Equity ETFs for the first week in 4 saw outflows, this time to the tune of about $3.6 billion. At the top of the group, and as we would expect when we have a risk-off, Spider Gold saw about $2 billion of net inflows. Spider S&P 500 though, S&P 500 ETF, the SPY, saw about $1.3 billion in net inflows. And at the bottom of this group, we see iShares Core S&P 500 ETF lose about $1.9 billion, and the iShares Russell 2000 ETF lost about $1.7 billion. And totally, remember I told you to keep in mind the negative return or negative flows that we saw on the conventional fund business side. On the equity ETF side, we saw year-to-date net inflows of about $32.9 billion. It's not a lot to write home about, and in fact, you'll see here in just a few moments that fixed income funds have outdrawn them almost twofold. But again, at least they are taking in that new money while conventional funds are basically handing it back. Let's go ahead and move on to the taxable side of the taxable fixed income side of the business. First, looking at conventional equity funds. Fixed income funds for the first week in 8 saw outflows, $1.4 billion. A little bit of head scratcher considering we had a 25 basis point cut by the Fed. You would think that people would have kind of climbed on board. We actually had a flat performance first week in 3 that we didn't have negative performance. This time to the tune of 0.00, and we go out there and we actually get a little positive, but truly it was just a flat performance for the week. Government mortgage funds actually took in about $170 million. Government treasury funds took in about $150 $251 million. And then flexible funds basically saw the big outflows, $1.6 billion. Year to date, this group, however, even though we saw a little bit of outflows this week, it's taken in $114.9 billion. That's quite a difference than what we have seen in the conventional fund business. Let's go ahead now and turn our attention to the taxable fixed income ETF side of the business and see what happened there. We see about inflows of about $1.8 billion. This is the 6th week in 7 they've had net inflows. And for the first week in 3 they had plus side performance, this time to the tune of just 0.23%. But again, remember I told you we had a shift at the short end of the curve. We saw rates drop by about 25 basis points, from the Fed cutting rates. And then I think what happened is yields actually changed a bit, and we saw a little bit of a downturn in yields as people pushed up, patting the coffers of fixed income funds as they were kind of seeking safety. At the top of the charts, as we'd imagine, with that safety comment, iShares 7 to 10-year Treasury bond actually took in about $1.1 billion, and the iShares 20-year Treasury bond ETF TLT took in about $1.1 billion as well. So we see that it really was, even on the ETF side, the authorized participants were actually patting the coffer of, I'm going to call it, less risky assets, even though they were going farther out in the curve. And that does make sense. I think the curve actually tilted up a little bit on the long side, tilted down a little bit, of course, because of the interest rate cuts on the short side. At the bottom, we see the iShares Short Treasury Bond ETF lost about $1.9 billion in the Spider Bloomberg Barclay 1 to 3 month T-bill, and this is BIL, lost about $357 million. Year to date, and this is one of the points I was making, we have seen into the ETF fixed income universe $87.3 billion enter that coffer. Well, that brings us to the tax-exempt side of the fixed income universe. And let's go ahead and take a look at the conventional mutual fund side again. Munis saw that for the 38th consecutive week, net inflows, $1.4 billion as far as the net inflows go. It's the first week in 3, though. They've seen plus side returns this time to a whopping tune of 0.43%. I know that doesn't sound like a whopping return number, but if you keep in mind, this is on a weekly basis, and these are munis. That's a pretty handsome return. General insured muni debt funds actually took in the lion's share of the money, and I'll have to say at least a third of the money, about $430 million. And then we see high yield munis taking in about $409 million. And then if we take a look at the muni bond fund side of the ETF universe, we saw that it took in about $276 million, which is actually pretty big for them. They've been in the 60s, 70s, and 80s, and now they're in the multi-hundreds. Muni bond funds, both conventional ETFs year to date, have attracted $68.8 billion. That actually is a pretty amazing feat for this group. So keep an eye on that one. That brings us now to the safe haven play, and that's money market funds. Let's go ahead and take a look at that. We see that for the 4th consecutive week, we've had net inflows this time to the tune of $37.8 billion. How it broke out is taxable money market funds saw about $37.7 billion in net new money coming to that group. And if we break that down even further, we basically see that institutional funds accounted for $33.6 billion of those inflows, while the retail universe money market funds saw about $4.1 billion in inflows. And tax-exempt money market funds actually saw some slight inflows, about $145 million. Year to date, we have seen into the money market fund almost a third of a trillion, actually a little bit over a third of $1 trillion of net new money coming to that group, obviously setting up and being ready for play. The actual number was $354.2 billion that we've seen come into their coffers. Well, that pretty much is the end of this conversation, but we really heard some good news today. New orders for durable goods rose about 0.2% in August, but the only thing that I think investors are really going to keep their eye on right now is the escalating trade war in China. And actually on Friday, on Wednesday, we actually heard that that the Trump had actually tweeted out that he thinks that there's going to be some resolution and maybe some quick deals done, but this is a little bit like the Lucy and Charlie Brown football episodes. Are they going to pull that ball away from us and let us drop? But anyway, so we're going to be keeping an eye on that. Obviously, we're going to be keeping an eye on what's been happening with the impeachment inquiry and what's going on, and see how that affects it. But again, I think really all eyes are going to be on China and what's going on right now. So far, the impeachment hearing, inquiry, actually, I think is what they're referring to it now, has really been kind of not on the radar for a lot of trading folks. Well, if I haven't done a deep enough dive for you, you can go to our site at www.lipperusfundflows.com, and then after that, please join us next week when one of our analysts will give you the flows play-by-play for that particular week. Thanks for joining me. My name's Tom Roseen, wishing you the best in your wealth planning and creation.